It wasn't the Federal Reserve's aggressive interest rate hikes. It wasn't the collapse of Silicon Valley Bank. It wasn't even the paralyzed political gridlock in Washington. It was the silent rupture of the global capital cycle. The mechanism is invisible to most. The consequences are not for 50 years. The arrangement was simple. They send us goods, we send them paper. They recycle that paper back into our debt. It kept interest rates low. It kept shelves stocked. It allowed the empire to borrow without consequence. That cycle is now broken. The arithmetic is merciless. When the largest foreign creditor stops buying, the price of money must rise. When they start selling, the foundation cracks. This isn't a political dispute. It is a structural inevitability. The pattern is unmistakable. Liquidity is the oxygen of the financial system. When it is abundant, mistakes are forgiven. When it evaporates, solvency becomes a myth. Current data suggests the liquidity drain is accelerating. Foreign official holdings of U.S. Treasuries are dropping. Gold purchases by Eastern central banks are at record highs. The incentive is clear. The payoff is sovereignty. The risk is systemic seizure. Under these constraints, the rational move for a rival power is to exit the dollar, and the rational move for the hegemon is to print the difference. We are watching a geopolitical margin call. History shows us exactly what happens next. It does not begin with an explosion. It begins with a shortage of cash in the plumbing. It ends with a fundamental restructuring of society. The timeline is the only uncertainty. The destination is fixed. 3 specific empires faced this exact liquidity wall 3 times. The outcome was identical. The first case study takes us to the Roman Empire, specifically the crisis of the 3rd century. The year was 235 AD. The dominance of the legions was unquestioned, but the cost of maintaining the empire exceeded the tax base. The emperors chose the monetary shortcut. The Severan dynasty began systematically debasing the silver denarius to pay the legions on the frontier. The silver content dropped from nearly pure to less than 5% in a matter of decades. The liquidity crisis arrived not as a lack of coins, but as a lack of trust. Merchants refused to accept the currency at face value, demanding payment in goods or pure bullion. The state responded with price controls, which only emptied the markets. A soldier on the Rhine frontier found his pay increased in nominal terms, yet he could buy less grain for his family than his grandfather could with half the wage. The middle class was wiped out, forced to sell their land to the ultra-wealthy simply to pay taxes, creating a feudal system of serfdom long before the Middle Ages officially began. Just like Rome, the Spanish Empire in the 16th and 17th centuries faced a crisis of external dependency. Under Philip II, Spain was the master of the world, fueled by galleons of silver from the Americas. But the empire did not produce, it consumed. Spain outsourced its manufacturing to the Netherlands and its banking to the Genoese. The liquidity of the Spanish crown was entirely dependent on foreign bankers rolling over short-term loans known as asientos. When the silver shipments were delayed by storms or pirates, the liquidity dried up instantly. In 1557, Philip II was forced to declare the first sovereign bankruptcy, converting short-term liquid debt into long-term, illiquid juros. The Genoese bankers, realizing the risk, pulled back their capital. The result was a century of inflation, stagnation, and the hollowing out of the Spanish middle class, as the price of bread and castiles soared beyond the reach of the common laborer. Just like Spain, the British Empire in the 20th century learned that currency reserve status is a privilege, not a right. By the mid-20th century, Britain was heavily indebted to its colonies and allies, holding vast sterling balances abroad. The liquidity crisis came to a head during the Suez Crisis of 1956, when Britain attempted to assert military power in Egypt. The United States leveraged its financial dominance. President Eisenhower threatened to sell the U.S. reserves of sterling bonds, which would have collapsed the British currency and triggered a catastrophic liquidity crisis. In London, Britain was forced to withdraw, humiliated. The subsequent decades saw the steady decline of the pound, capital controls, and the 1976 IMF bailout. The British savers saw their purchasing power erode as the government chose inflation over austerity to manage the structural deficit. The pattern repeats in 7 distinct stages. Stage 1 is peak dominance, where the empire enjoys the exorbitant privilege of printing the global reserve currency. Stage 2 is the imperial overreach, where military and social costs exceed productive output. Stage 3 is the monetary shortcut, where the state covers deficits by issuing debt that foreigners initially buy. Stage 4 is foreign rejection, the current phase, where creditors realize that debt is mathematically unpayable in real terms and begin to exit. Stage 5 is domestic inflation, as the central bank becomes the buyer of last resort to prevent a liquidity collapse. Stage 6 is the flight to hard assets, where capital flees financial paper for land, gold, and commodities. Stage 7 is social fracture, where the priced-out middle class demands radical political change. Just like Britain in 1956, the United States is now facing a creditor revolt. Current data suggests that China and other major trade partners are actively reducing their exposure to long-term U.S. Treasury bonds. They are redirecting trade surpluses into gold and strategic commodities, rather than recycling them into American debt. This withdrawal of liquidity is forcing the U.S. Treasury to issue more short-term bills and forcing the Federal Reserve to manage the yield curve. The warning signs are flashing in the bond market volatility and the divergence between the paper price of gold and the physical demand in Shanghai. One interpretation is that the dollar's network effects are too strong to break and that there is no viable alternative currency. This is that there is no alternative argument. However, this ignores the incentive structure. The incentive for rival nations is no longer just economic efficiency, it is national survival. The weaponization of the dollar sanctions regime has made holding U.S. debt a national security risk for any nation not fully aligned with Washington. Under these constraints, the rational move is to diversify, regardless of the short-term friction costs. The arithmetic is merciless. If the global demand for dollars drops, while the supply of dollars expands, the value must adjust downward. History indicates this ends in one of 3 ways. The first endgame is controlled decline. This involves a long period of financial repression, where interest rates are kept below the rate of inflation to slowly liquidate the real value of the debt. This occurred in the United States and United Kingdom following World War II, where savers effectively paid off the war debt through negative real yields. The second endgame is chaotic collapse. This occurs when the bond market vigilantes refuse to accept negative real returns and stop buying entirely, forcing the central bank to print explicitly to cover government bills. This leads to a hyperinflationary crack-up boom, similar to Weimar Germany in 1923 or Zimbabwe in the 2000s, where the currency becomes worthless and the economy reverts to barter. The third endgame is reset and restructure. This typically involves a global conference, a revaluation of gold or a new reserve asset, and a formal default or modification of obligations. The Nixon shock of 1971 was a soft version of this, ending the convertibility of the dollar to gold. A future reset might involve central bank digital currencies used to lock capital within borders while the debt is restructured. The only variable is timing and pain. Subscribe to the channel to follow this analysis.